is not a bottoming formation. Instead, it's a manufactured illusion of strong support. Gold's sideways consolidation near the 4,000 mark over the past few days, designed to lure impatient sideline bulls into entering early, thereby creating enough counterparty liquidity for the next major leg down. The latest intelligence suggests Trump is planning to expand strikes against Iran, with the probability of weakened military action on the rise. If geopolitical tensions boil over, we could see gold gap down on Monday's open, allowing the market makers to sweep another massive pool of liquidity. More importantly, the current macro environment offers absolutely zero fundamental support for gold to stabilize at these levels. Today, the Bank of Korea announced its first rate hike in 3 years, and keep in mind, South Korea is widely regarded as the canary in a coal mine for the global economy, and its stock market it's its absolute crown jewel. When even Korea is forced to buckle under pressure and restart rate hikes, it's ironclad proof that global inflation is far steeper than the market wants to admit. So this sideways grind is purely a fake out. Don't fall into the trap of thinking this is a button. Now, let's dive into the Fed's balance sheet runoff and rate hike expectations, as these remain the primary drivers of gold. A lot of traders got whipped around by Walter's tweet during yesterday's hearing, questioning whose side he's actually on. My thesis has always been clear. He is a dove in wolf's clothing. Highly calculated, politically savvy, and incredibly smooth. In my view, his refusal to take a definitive stance, combined with his seemingly hawkish dissatisfaction with current inflation metrics, is actually constrained by two factors, namely oil price and AI-driven inflation expectations, alongside the need to maintain the Fed's carefully crafted facade of independence. If the geopolitical situation deteriorates further, crude could easily surge to 90 or even 100. Under such conditions, making definitive calls on rate cuts or pauses based solely on last month CPI and PPI prints would be incredibly reckless. More importantly, under the intense spotlight of the hearing, if he were to show his hand too easily, it would inevitably raise suspicion about whether he's playing backroom politics with Trump. Therefore, preserving his independent persona is paramount. Furthermore, to offer a counterintuitive take, the more hawkish Waller acts right now, the smoother the eventual path the rate hikes will be. This also plays directly into supporting the next phase of AI expansion. Remember the June FOMC minutes? AI-driven inflation was officially listed alongside tariffs and oil as one of the three major threats to U.S. price stability. But their dynamics are fundamentally different. Tariffs and oil are external shocks, open up the shipping straits or lift a few tariffs and the pressure eases. In contrast, AI inflation is an internal structural loop. It's a vicious cycle. Skyrocketing storage costs drive up consumer electronic prices, while massive data center expansions trigger grid shortages and driving up electricity costs. Meanwhile, building a new nuclear or solar capacity in the US is a painfully slow process. These deep supply-demand mismatch guarantees that AI-driven inflation will remain structurally sticky for the long haul. Until this AI inflation time bomb is diffused, any premature dovish pivot from water would trigger a massive market meltdown. Corporations will ramp up capex, leverage will surge, and consumers would keep borrowing, reigniting the inflation fire and forcing the Fed to slam on the brakes at an even higher terminal rate. Thus, this current hawkish rhetoric is simply a preemptive strike. He is using a loud hawkish voice to suppress market expectations and buying precious time for the AI supply chain to scale up and allowing inflation expectations to cool down naturally. It's not a prelude to more hikes. In fact, you could argue his current stiffness is merely paving the way for future softness. Why? While he dismissed certain core PC metrics during the hearing, the Fed's semi-annual monetary policy report quietly introduced a new methodology. Under his new metric, inflation is cooling. Under the old one, it's still rising. The moment they actually want to cut rates, they have the perfect narrative ready to flip. That's his Waller genius. He barks like a hawk, but bites like a dove. From this perspective, gold faces clear, heavy headwind in the near term, and thus my short-term outlook remains firmly bearish, while my long-term structural bullish thesis remain intact. Let's talk about crude oil. Short term, I'm definitely still looking at the upside. After a streak of green days, the chart is just moving sideways right now. It looks a lot like it's pausing for refuel. The reason is we've got the USEI inventory data coming out tonight at 10:30. Until those numbers actually drop, the bulls aren't going to rush in, and the bears definitely don't have the guts to smash it down. Even though I personally feel it's probably going to lean bullish, you guys trading this shouldn't try to guess. Just wait for the direction to clear up before you jump in. It's never too late. And plus, tomorrow is Friday, and let's face it, almost every weekend lately has been pretty messy. The latest shipping trackers show that oil flow through the strait is still dropping and basically hitting the lows we saw before the peace deal. If we get even a hint of conflict escalating over the weekend, crude is highly likely to gap up right at Monday's open. One last quick heads up. The second crude oil makes a move, downstream chemicals are absolutely going to flow. If you pay attention, there's definitely something worth digging into there. Okay, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.